Markets have been exceptionally volatile since mid-November as investors have digested the impacts of rising inflation, pending Fed actions, the potential end of the COVID crisis, and the tragic situation in Ukraine. Rising interest rates have reduced what investors are willing to pay for growth and cash in the future businesses, and may increase the risk of recession amidst the inflationary backdrop of rapidly climbing fuel and food prices. Even though rising rates reduce what investors are willing to pay for higher growth companies, they are also usually indicative of a strong or improving economic backdrop, which tends to be good for more economically sensitive small and mid-cap businesses. Economic conditions appear robust in the United States and Europe, but so is inflation. As central banks begin to raise rates to rein in inflation, economic activity likely loses some momentum and serves as a moderate headwind to the near-term growth prospects of less diversified, smaller and mid-cap companies. Investors are anticipating this, which has driven valuations down meaningfully. What do we think the market is missing? Well, we believe that well-capitalized, cash-consuming companies with strong unit economics and leadership positions in large and secular growth markets can be excellent businesses under any kind of rate scenario. In volatile periods like the one we find ourselves in today, companies with these attributes can leverage their leading position and easier access to capital to consolidate share and pull ahead of their capital-constrained peers. We pay close attention to where companies generate their revenues to understand their short and long-term growth prospects. Given Russia's actions in Ukraine, we believe the risk of recession is on the rise in Europe, which makes us more cautious towards companies with higher European exposure. We anticipate a modest near-term impact to the production of semiconductors and technology hardware as nickel and titanium, along with semiconductor-grade gases including neon, xenon, argon, and krypton, are sourced in part from Ukraine. China's increasingly stringent and opaque regulatory regime has also kept us from investing in companies in the country. Conversely, we have greater confidence in companies with higher leverage to the U.S. economy and higher growth emerging market companies throughout Asia. The case for investing in technology companies is compelling, regardless of where we find ourselves in the economic cycle. Enterprises and consumers invest in technology to drive better productivity. We think enterprises are most willing to accelerate their investment in technology when they see their own prospects improving. The inverse is also true, though, of course. In addition, if inflation headwinds persist on the labor side of the market, we believe enterprises will look to technology and business process improvements to better manage their costs. Such investments would be a tailwind for our digital transformation thesis, which could help to offset recessionary headwinds.